Hello everybody, welcome to my first video. Today we'll be talking about the basics of exchange traded funds, or as some people know them, ETFs. So firstly, let's define what an ETF is. So it stands for exchange traded fund. Exchange traded, meaning it's bought and sold on a stock exchange, similar to a stock. You or I could buy it, search up the ticker symbol and purchase the ETF. The fund portion means it's a collection of many securities, like stocks. So how I like to think about it is or represents a basket of stocks, a basket of companies. So when you buy an ETF, rather than buying one particular company, you're buying into a collection of companies. So let's compare ETFs and stocks to better understand what an ETF really is. So when you buy a stock, you're owning one particular company. You become a part owner, literally, in the company. If the stock goes up, you make money. If the stock goes down, you lose money. Compare that to an ETF, where instead of becoming a part owner, or instead of being affected by the movement of one particular stock, effectively, your money is spread out between companies. So if one stock goes up or one stock goes down, it doesn't make a huge difference, but over time, because these stocks are generally going to move up, your investment is going to increase in value. So effectively, it spreads out your risk. It does, to an extent, also spread out your potential success and cap it. But for the average investor, especially one early on, I think it makes very good sense. So let's further this analogy with stocks versus ETF in a pizza. So it might seem a little silly, but let's say each piece of pizza represents a stock, and as a whole, the pizza makes up an ETF. So to kind of visualize and understand the risks of stocks and the lower risk of ETFs, let's consider you pick a random piece of pizza. Let's say you take a bite and you don't like it. Well, really unfortunate, because let's say you're at a party and suddenly all the other slices of pizza are gone. Or if we're applying this to finance, let's say you spent all of your money on this one stock and you don't like it. Really unfortunate. Too bad. You probably lost money. Sure, there are a lot of examples where this is not the case, but let's for argument's sake, say the piece of pizza was bad. In comparison, let's say the pizza as a whole represents an ETF. So an ETF, a collection of multiple pieces of pizza. You have stocks in all sorts of different industries, different interests, different sizes. So if you were to purchase the pizza as a whole, maybe you can take a little bite of each one. Some are going to be better, some are going to be worse, but the point is it's going to average out to a much higher value. It's going to be a lot safer. You don't take the risk of the single piece of pizza. So for a lot of people, that's a very intriguing idea. So let's say you own Apple, for instance. So you took the route of owning one stock rather than an ETF. So let's say Apple falls 30%. If you were to invest $1,000 in Apple up front, suddenly you only have $700. This highlights the inherent risk of owning individual companies. In comparison, let's say you bought an ETF that happened to have Apple in it. So I took the example of the QQQ, which represents the NASDAQ, one of the more popular ETFs out there. So if you were to own Apple, it goes down 30%, you lose 30% of your money. But if you own QQQ and Apple goes down 30%, suddenly you only lose a little under 3% of your money. And that's because Apple only makes up an 8.85% share of QQQ. So rather than tying up 100% of your money, you're tying up a little under 9% of your money. So I say all this, but what can we actually get out of ETFs? Sure, they seem safer, they seem easier, but how is this actually going to affect you and me? So there are two kind of routes I see with ETFs. One are ETFs that mimic the market. For instance, the S&P 500, that's very widely followed. And then there are other routes with ETFs. There are ways to get creative with them. There are particular industries that have ETFs. So on the left, I listed the S&P 500 ETFs, some of the most popular. And on the right, I listed some other ETFs that people are pretty widely interested in. So the left, while they're more popular, they're also simpler. They are very practical. They're very helpful for new investors. You know, if you started investing and all you knew was to put your money in VOO or SPY or IVV, you would honestly be above 90% of people out there. Because the S&P 500, you know, when people talk about the market's return or how much does the market return, how much are you going to get investing this year, how much am I going to make if I invest for 10 years, they're almost always referencing the S&P 500. If you own one of those, you're going to get that exact value, plus or minus 0.5%, and you're going to do really well for yourself. For people interested in a little more, not diversification, but maybe a little more excitement, a little more, maybe they're seeking to outperform the market a little bit, you can go down different routes. You know, the ARK Innovation Fund is very interesting. It's very tech focused. The JP Morgan Income Fund, if you really like dividends, and the Spider Gold ETF, if you're interested in gold or precious metals or anything like that. You know, for the vast majority of people, you know, I'd probably point them towards the SPY VOO route. Of course, that's not financial advice, but for me, that's how I got started, and I thought that was a very apt way of beginning. So if we were to take the average return from the S&P 500, I know you saw the 12.8 figure, but let's use a more conservative 10%, which I think is more representative of, you know, maybe the last 20, 30 years. If you were to invest $5,000 and just hold the stock for 10 years, hold the ETF rather, you'd have $13,500. Now, I'm not sure quite what you expected going in, but to me, that's a very impressive figure. That's you not spending any time picking stocks, you're not reinvesting your money, you're basically just putting your money in the S&P 500 and letting it go. And to me, that seems like a great deal, especially if the $5,000 would otherwise just be saved. Maybe in a interest-bearing savings account, but maybe not. Maybe in 10 years, it's just $5,000. So think about all that potential where you could tap in just by being involved in ETFs, just starting from a pretty simple place, but, you know, yielding a lot of return. So to further visualize this, you know, I showed the chart, and to me, the most interesting part is that in year one, your interest is $523. So make $523 on your $5,000. Fast forward to year 9, suddenly you're making $1,161. So that same 10% interest is suddenly worth a lot more, which to me is really exciting. And it really highlights the importance and the value of compound interest, which as a beginning investor, I think that's one of the most important terms and most important concepts to really embrace, because I think that will really motivate you to continue investing. So I really hope you enjoyed this video. I hope you learned a thing or two about ETFs. And thank you. Have a nice day.